Restless, I am gonna make you mine.
Hello and welcome to Looking at the Markets with David Modell. I have one of my favorite guests here. He is Mr. Lior Gantz from wealthresearchgroup.com, and he is a wealth of information. We have so much going on in the markets, and I've got Mr. Gantz here to let you know what he sees in the markets right now and maybe some ideas of what you as an investor can do to approach these tumultuous times. Mr. Gantz, welcome back to Looking at the Markets, sir.
Thank you, David. Glad to be here.
Yeah, absolutely. And I recommend people check out wealthresearchgroup.com. Link is in the description below this video. And we may have some other links as well to some free resources, possibly. All right, so this is an election year, and not just any election year. This is one of the most divisive times in American history, almost Civil War kind of stuff going on here. We got Sleepy Joe Biden, as some people call him, and we got Donald Trump, who is a lightning rod of a president. So what do you see in the economy, and how can investors approach these crazy times?
So the first thing is, statistically, if you look back at other elections that are tight do weigh on markets. Historically, when it's very clear who's going to be the winner, investors can trade with much more certainty as to what the policies are for the next few years, etc. And now it's not. It's really tight. It's going to come down to about 100,000 voters. That's how tight it is. So if you obviously followed the 2016 elections, the Trump campaign really targeted on Facebook, literally almost like a door-to-door, but on social media. So they got to that county, that one county where the people decided the elections for the 2016. And right now it looks like it's going to be as tight as 2016. The Trump campaign is doing almost like the same thing. It's really trying to target. The budget is much bigger than 2016. It's much bigger than Biden's. So we shall see what happens. But the fact that it's so tight is really weighing in on markets. And then what's really making it even more interesting is the fact that the Federal Reserve does not want to seem like it's meddling. So it does not act aggressively in September and October. So right now we have freer markets. And that's actually good if you're a long-term investor, because you can see really where the support is for some of your companies that you're looking at, because the Fed is not pushing the throttle ahead like it was March, April, May, and onwards. So I think those are two key themes that are happening. Actually, when August ended, we published in our newsletter that September is going to be the most dangerous month for stocks of 2020, after March and April, of course, because of the election. And then I am sure you follow this. Options, the options market, where statistically 88% of options expire worthless. It was in such a euphoric bubble, and in terms of like the duration, it was 2 weeks that people were betting on. So the day trading activity and the millennial activity in Robinhood, etc., was so big that markets needed a healthy correction. And what's happening right now is actually the institutional money, the hedge funds, those that said, hey, we're waiting for March lows in order to come back, we're waiting to retest the lows. They're seeing that the pandemic is very contagious, but it's not lethal. And therefore, they're not waiting for March lows, because the circumstances are not there to create another March low type environment. You will not see the markets go down 35% from here. At least that's Wall Street's view on it, and it's actually my view on it. I'm not expecting most stocks or most companies to be priced at March lows if their industry isn't one of those really distressed ones that are directly impacted or are actually closed because of what's happening with COVID. So that's kind of where I'm at. So how do you trade around it? The one thing that we have done since March is we issued watch lists. Those are great because I can always look at companies that I predetermined that I love, and then I want to own them at a certain price. And because I create a database of about 50 of them, I don't need all of them to hit, because what I'm trying to hit is a bargain price, a stink bid. So we published wealthresearchgroup.com/list. That was back in March. If you look at the 14 companies that were there, I think 10 or 11 hit their limit order. So they got as low as we wanted. And the returns have been upwards of 40% for all of them. We then issued list, so wealthresearchgroup.com/list2, list in the number 2. That was in May. And we said, look, wait until the market peaks, and then you can look at these proposed ones. And that was, the market peak was in June 8th, if you remember. Some stocks have not recovered to the June 8th highs yet. Many have not. Out of the S&P 500, 300 companies are below their 2020 January 1st, 2020. So they're down for the year. 300 out of the 500. That shows you how indexing has really helped a lot of investors, because 5 companies basically, or 8 companies now, we call them Fang Man. That it includes 3 more companies in them. That actually elevated the indices to where they are because of the concentration, the weight that they play. So we issued list 2. The companies that hit those limit order, they were also upwards of 30-40%. And then we issued list 3, so wealthresearchgroup.com list 3. And now with the NASDAQ correcting, we actually issued wealthresearchgroup.com/tech, which are solely focused on tech. So that's the way we approach that. We predetermine companies that we like, predetermine the prices. If they go there, then that's good. If they don't, then we just move on and build that database. And that's stocks. I think really what's really important is not to just look at stocks. Bonds are the most expensive asset class because you're basically paying for and getting nothing. So I avoid bonds personally, and obviously the younger you are, the more it plays to your advantage to avoid bonds, because you have 30 years or 40 years ahead of you that you want to accumulate equities. So what I do in 2020 is I look at private real estate funds. So not publicly traded REITs, but private funds. It helps if you're an accredited investor, but some of them are open to just retail investors. And what I love about them is the panic that you saw in March in stocks, you did not see in real estate, even though they're obviously correlated. Jobs, earnings, etc. Everything impacts prices of real estate. But because they're so different than stocks in terms of, like, you just can't buy and sell all the time, prices remain more stable. And because hoteling, casinos, development, etc., that's off the table for many investors, the money is flowing strictly into residential, and that's really helping if you have exposure to that kind of real estate. So I've put a lot of money into either equity in real estate or to debt funds. That's also really good because the interest rates are about 8 to 10% right now, and you're getting collateral of multiplex complexes. It's not like you're not lending. This is not private lending, so you're not lending to a contractor on one house. There's a pool of 300 doors, etc. So look at those, and then obviously I like to put a lot of the cash into gold and silver. That has been a really good decision in 2020 for sure. Diversification, watch lists, real estate. That's the way I look at it. No matter if Biden or Trump win, the general idea is everything is better than bonds, and money cannot stay in cash. So you need to just look at where the relative value is appropriate, and people are looking to get back to those levels of P ratios that may not exist anymore. in a world of zero rates. And that's where a lot of people get it wrong. They just sit on a pile of cash and they say, I'll go back when the S&P 500 is at a P ratio of 15 or 16. And they have to remember that in that world, interest rates were 4 and 5 and 6%. So there was a lot of alternatives to stocks. So stocks were cheaper, and because they needed to attract investors. Right now, it's not the same way. And we may live in a world where stocks are not only more expensive, but some of them, like Apple or Amazon, Google, Microsoft, those are not really just companies. Those are safer investments than government bonds. So they get a premium for being much safer than lending money to Washington, which has been considered in the past 60 years as the most safest investment ever. So think about that, because you may not get a chance to invest in those historical lows that you saw in March if you didn't.
Talk about an election-proofed portfolio, and that's great diversification right there. I want to make it easy for people. I actually own these reports, and I want you guys watching this and gals watching this to get them too. Go to the description below this video, click on the links. We have a couple of reports here with watch lists with target prices where you might want to buy these stocks at in the reports. The first one is wealthresearchgroup.com/list3, number 3. The other one, if you're more tech oriented, wealthresearchgroup.com/tech, TECH. Again, they're in the description below this video. Just click on them, get those reports. I got them, and I'm following them every day. I don't know.
Of course, do your own research and whatnot, right? So,
and
these are a point of reference to look at.
It's just a point of reference. We're not telling you what to buy, what to sell, or anything like that. It's just absolutely just ideas. Now, I believe in value over growth. That's just my approach. Do you see a return to value? I mean, I know you just alluded to the S&P 500 not realistically going back to 15 or 16 PE ratio, and yet growth versus value, it is so skewed toward growth, toward momentum stocks. Will the Warren Buffett style ever come back?
Actually, that's one of the best questions I've been asked in a long time, and I literally wrote in the newsletter an entire article devoted to it in the free newsletter.
Yep.
Just last week. And my answer is Warren Buffett his mentor was Benjamin Graham. And Benjamin Graham grew up investing in the Great Depression era, where the way you would value a stock is you would say, let's pretend like it has no future. I don't want to speculate that it's going to grow at all. I want to see the nuts and bolts of it, so what's called the liquidation value, and pay no premium at all. And that's the classic value investing. Now, in today's world, if you try that, you probably invest in one company a year, and that company is probably on the verge of bankruptcy, because those days of all public companies trading with no premium, with no multiples, like in the days of the Great Depression, are over. Buffett understood that, and he evolved from that, and you can see a real evolution from the 50s and 60s, where he was literally investing in that. He called it the cigarette butt investing, where you'd find like a cigarette that was already smoked, and the guy was putting it out on the floor, and there's one less puff, and you take that puff, and it's a free puff because it's on the floor. That was his style of investing at the beginning. He tried to find companies that were trading below their cash on hand or stuff like that. It's almost impossible today. And think about it. If it was really possible as a strategy, you have supercomputers that would just find those on the indices. So that's not the way to work. Then he evolved and he said, look, I want to find the best companies trading at a fair price. And Buffett's way of doing it was he was trying to find companies that have a pricing power where they can raise prices without raising the quality of their product. So basically you raise prices because you can, and you want to beat inflation. So he found Coca-Cola, and he found the companies that made him really rich, like Geico Insurance. That's his crown jewel. But a lot of private companies. So if you look at Berkshire Hathaway subsidiaries on Wikipedia, you look at 100 companies that are private, you will see that many of them have a lot of brand loyalty, and therefore they raise prices with inflation, even though the can of Coke or whatever it is, I'm just giving an example that everybody understands and knows, is there. So he was looking for that magic type of company. But then look at the last 25 years. Since 1995, he has not been returning better than the indices. Why has that happened? And it's because we have changed. Amazon basically is a company that changed the world, because Amazon proved that you can grow and grow and grow and grow and grow. And the way you grow is you keep expanding your reach into newer ventures, and you can penetrate markets and change markets. So a company that starts up with selling books online, which is what Amazon was. If he was pitching it and he pitched it to David Rubenstein of Carlyle Group, the best private equity in the world, and he told him, Jeff, good luck. This was when it was private. So, just understand that when Bezos had a problem convincing the best investors in the world to put money in Amazon. And it's because they only saw the vision of a book. So now what analysts are trying to do is say, okay, Amazon sells books online. Okay, what else can it sell? How much can it scale? They're looking at growth, because growth is now part of the toolbox for investors. We are not in the Great Depression era. We are not fearing that most companies are going to go belly up. We live in a world where less and less companies are going belly up, because they have better management, more access to this, to that, more international exposure, overhead is less, etc. So there's a lot of value traps. There's a lot of companies in a lot of industries that get disrupted not in decades, but in a few years. And therefore there's this shift into what we call growth. But basically, what is growth? Growth is a revolutionary way of doing a business that's already existing, through the cloud, through 3D printing, whatever is happening right now, through the Internet of Things, etc. So my point is, there's the value companies, or the value stocks, the blue chips. Some of them are value traps and some of them are not. And you have to find out which is which. For example, ExxonMobil is trading at 20-year lows. Yep. And it's because oil is, it's not going away. People are going to we will need oil. But solar is becoming so cheap that it's going to top oil. And so you have to look at a company like that and say, is this value because there's a 9% dividend or whatever? Or is this a trap because there's a 9% dividend, but my equity position is going to drop by 5% every year for the next 20 years here? So that's the difference. Some companies are actually dominating an industry where it's hard to disrupt them. And if there's somebody that disrupts them, they can buy them out, etc. Some companies are industries where that cannot happen. So there's no, it's not a simple answer where you say, okay, so just stick to growth or just stick to value. I have both. And what I also love to do is I love to buy the index and then look at names that I think have that I have high conviction on, and put it on top of the index. So the index would be 80%, and then the names would be 2-3% each. That would get to 100% on that on value. And then I would do the same on growth. And if I think growth is more expensive than value right now, which it is, then I would put more in that value box than I would put in the growth box. But as you can see, in the last 10 years, if you were not invested in one of 10 names, then you missed out on so much. So that's the value of having an index fund exposure and not just picking stocks on your own. And it's also something to think about, a lesson to think about, where it could be a company that is as easy as, hey, I have a phone in my hand it's an Apple phone. I need to look at Apple. And that is the way that Peter Lynch in between 1977 and 1990 returned 30% a year for his fund. He's the best fund manager of all time. And he's the guy who got me invested in stocks at the age of 16 when I read his books for the first time. And he was saying my daughter, like his daughter, who was in middle school, she picked some of my best stocks. And the way she did it was she just said, Dad, I like this, I like that. And he was looking at those companies. So it's really important to think about all of that. And if you're a part-time investor, you have less time to think about it. You need to rely more on the indices. If you have more time to think about it, then you can really do some research. The difference would be pretty large over 30 years and 40 years, but not large in terms of a few years' time. So that's also important to take into effect. Growth is not like in the early 2000s, or I should say in the late 90s, where it was worth but not warranted. The internet was revolutionary. The companies that were trading had nothing. Today, the FANGs, they're household names, and they actually bring a lot of value. So it's not like they're going to sell off 90% or something like that, like in the dot-com days. So that's at least my opinion. You will not see those types of crashes. Literally, a pandemic that froze the whole markets up, took the markets down by 35%. So think about that. That's kind of where the support is for stocks, because that was the worst sell-off in history. $30 trillion in bonds and in stocks went to cash. Yeah. Everything froze. Usually you sell stocks, you buy bonds. Here people just sold this and this. They literally thought, man, I don't know anything of what's going to happen. And you saw what happened. So that gives you an idea where the floor of the floors is for the stock market as a whole.
Interesting. Okay. And one more if we have time, if you have time. Barrick Gold shares were purchased by Berkshire Hathaway. I don't know if Warren Buffett was even behind the Barrick Gold purchase or not. Is this significant? Is this a great time for value investors and growth investors to start getting into the resource stocks? What do you think?
Personally, about the first speculation, I think it was Ted and Todd. Because of the size of the position, it was $500 million. That's usually not what Buffett would be looking at. In terms of like why enter Barrick, which is a gold company, for Berkshire. So gold companies, if you take a global cut at them, they produce around all-in cost of about $1,200. If gold is trading for $2,000, the margin here is about 66%. That's pretty high. Some of the smaller producers, they trade for all-in 1,000. So they're making a margin of 100%. If you believe gold is heading higher, those companies start to have multiples that are amazing and margins that you don't get in other industries. The way you get 100% margin in a traditional industry, not a commodity, is you would have to have something that's a patent where nobody can compete with you, so you can charge a lot, or you do something, a service that is so unique that nobody else can do that service. It's really hard to get to 100% margin. The way you do it in the resource sector is you work for years during a bear market, which was if you look at the TSX Venture, from 2011 until today, it's down like 80%. So all these companies had to survive, and you survive by lowering costs, and you survive by going out of business and consolidating, going out of business. So that's what happened with the resource sector. And we reached a point where these companies have a really healthy balance sheet and good management teams, very disciplined. And so they're making a fortune, especially when you have a lot of industries that are in shambles right now. So that really helps resource stocks. And I think if you believe that gold is heading higher from here, then the resource stocks offer a phenomenal opportunity in general. And if you know what you're doing and you actually research specific companies, you have chances to put in 1% of your portfolio and make 5 and 10 times your money, and it's happening all the time. It's happening right now in 2020. It happened literally to a company that we covered on our portfolio that went up 1,000% this year. So I think that's it's a huge opportunity, and think about it. If Biden gets elected, the trade war with China will probably, relax itself. The need for many people to hold dollars would subside, and that will actually weaken the dollar even further. A lot of people, because Trump is agitating a lot of people, so they hold a lot of cash. And a lot of funds would go back into equities if Biden wins. So that will weaken the dollar. On the flip side, if Trump wins, then you have a situation where you already know what his mindset is in terms of interest rates. His dream is to refinance the entire national debt for 100 years ahead at zero rates. And I believe he will tackle that in his second term if he wins. So that's also really good for the economy because he's going to keep taxes low, etc. The economy will move faster if Trump wins, and the economy will be more relaxed if Biden wins. That's the perceived thesis. Both of them project a weaker dollar either way. So that's really good for gold, and actually especially good for silver. And then for base metals, you're already seeing what's happening with those. So definitely a place in your portfolio for resource companies. Probably one of the best times in the last decade to be involved.
Yeah, I agree 100%. Again, I want people to check out the reports, wealthresearchgroup.com/list number 3, and for wealthresearchgroup.com/tech, TECH. Links in the description below this video. They will send them right out to you. All you have to do is put in your email address for those and get the newsletter while you're at it at wealthresearchgroup.com. All right, Lior Gantz, thank you so much. I learned quite a bit about my hero, Warren Buffett, value versus growth investing, why to get into resource stocks right now, and how to election-proof your portfolio. And we're going to have you back here with an update pretty soon. Wealthresearchgroup.com has been just really so helpful and life-changing for so many people. So I want to thank you for your service to the investing community. Thank you, sir. Appreciate it today.
Thank you very much.
She whispers, I am gonna